Okay, great. Well, hi everyone. I'm Alex. I'm the co-founder of Sprintlaw, and welcome to this month's webinar. Today we're going to be talking about business structuring. Our presentation is titled Structure for Success, How to Legally Set Up Your Small Business. Just before we get into the content for today, for those who don't know us who aren't already clients or members, Sprintlaw is an online law firm really designed to make legal services simple, affordable, accessible for startups and small businesses. We provide fixed fee legal services. Unlike traditional firms, we're not charging you by the hour. It's always transparent, upfront, fixed pricing, as usually as affordable as possible in lots of different areas of law, everything from setting up your business, which we'll talk about today, all the way through to employment contracts, e-commerce, IP protection, data and privacy, employment law, and more. And for many of our clients, most in fact sign up to our Sprintlaw membership, which is an annual subscription and has a ton of other benefits. We've got a full member platform with free documents, legal health tools, an e-signatures tool, and some instant AI legal advice features, as well as credits that you can use on legal services with our lawyers, and free calls you can book in with our team for quick questions. So it's a great service. There's a free trial, a free tier for those that want to just check it out. You can sign up on our website. But yeah, that's sort of how we work. We've been around for about 8 years now, have lots of clients. We're originally from Australia, but have expanded now to the UK and New Zealand. If you would like to work with us. Also, if you are gripped by the urge to get some advice on structuring off the back of this presentation, we do offer free consults, so feel free to book in a time with our team. We'll show this QR code again at the end, and we'll also drop a link on the chat for those that want to book in a call. So let's get to the legal content for today. We're going to be talking all about business structuring. First, we're going to start with why does this matter? Why are business structures important for you to think about? We'll then go through the different structures. We'll start with the sort of simple distinctions between sole traders, partnerships, and companies, and then we'll look at more sophisticated structures, dual company structures, trust structures, and walk through a few different ways you might think about making this decision, which is an important decision, and when you might think about swapping structures. We'll also go through in a bit of detail for those in a particular structure that want to change, how that process can sort of look. We'll then talk a little bit about business names. How do you choose and protect the name for your business, which is a different process to actually selecting your company structure. And then we'll just quickly walk through some of the different documents that need to be prepared as part of this process and what they do. As I'm going through, we've got the Q&A feature in Zoom. Do feel free to drop questions along the way. I don't mind answering as I go. Often if it's on the topic that we're talking about, it can be nice to add some sort of illustrative information about what we're discussing. And also if we get time at the end, I'll also try and cover off any questions I didn't get to. So why are business structures important? One way to think about the structure of your business is almost like the frame of your house. And so you want to make sure you've set up the right foundation for your business, a foundation that gives you stability, and is a solid base for you to grow and achieve the goals of your business. So if you don't get the foundations right, it can cause problems down the line. Many friends of mine who are entrepreneurs, I know had the wrong structure early in their business grew, and later on they really regretted the way they set things up. It cost them, in many cases, lots of money in restructuring, and potential tax consequences, and in some cases, liability issues, in some cases, personal liability issues. And so, we see this with our clients all the time as well. People often go for the quickest, cheapest, easiest, simplest option at the beginning, and it actually ends up costing them more in the long run. So it is an important foundation to set and worth thinking about as early on as possible in your business, because the stronger the foundations, the better chance you have of success. So when you're operating a business in Australia, any kind of commercial enterprise, there is a requirement that you register with the government to say, I am conducting this commercial activity, a business, and you have to choose a registration type. And at a high level, there are three main types of registration that you choose. Firstly, you can set up as a sole trader, sort of a one-person business, simple, easy, cheap, online form you fill in, and it's pretty fast. You get yourself an ABN number, which is like a business number, and off you go. You can start engaging clients, sending out invoices, doing work. And when you do your personal tax return at the end of the year, there'll be a section in there for you to talk about, oh yes, and I had an ABN number and I made this sort of income. So it's very simple. It's very linked to your personal income that you might have had as an employee. And many people choose to operate in the sole trader structure as a simple way to operate. We also have a partnership structure people may have heard of. A partnership structure is quite similar to the sole trader structure, but for one or more people working together, two or more people working together. And essentially, those few people can again go register an ABN, get a tax file number for the partnership, and it will have its own sort of tax return. But from a legal perspective, it's still just the individual sort of working together. We haven't set up a separate entity or organization for the business, and it's different from what we have on the right, the company structure, which is really the most serious business structure and one that most lawyers would recommend that people conducting businesses consider setting up. A company structure, when you set up the business, you're actually setting up a separate legal person to yourself. So when you're a sole trader or in a partnership, it is you running the business. But when you set up a company, you're setting up a sort of fictional person, your company, PTY Ltd, which has its own bank account, which has, its own sort of identity that it can enter into contracts with. It can, sign deals, sign up to things. It is a separate legal person to you as an individual. Now, a company will have a director, which is sort of like the arms and the mind of the company. It can sign those documents on behalf of this fictional legal person, and then the shareholders, who are sort of the owners, the body, if you will, of the sort of the fictional legal person. But the company itself is another person, and you might think of it in that sense. And so what that means is, and the big significance here from a legal perspective is, if something goes wrong in the company, someone tries to sue you, it gets into hot water, it runs out of money, its liability is in most cases, not all cases, in most cases limited to the company. So the individuals behind it, those directors and shareholders, in most cases won't have any liability for issues in the company. And this is really powerful because when you're doing business, you're going to be out there moving money around, potentially taking risks. And if something goes wrong, which it may, in most cases, you don't want that to come back to you, your personal assets, your car, your house, anything that you might own. And if you're operating as a sole trader from a legal perspective, there's no difference between you, the individual, and you, the business owner. And same in a partnership. There's no legal distinction between you and the business. If two people running a partnership get into trouble and are sued by a client, the partners will be liable, in most cases 50-50, personally for the issues that emerged. If you've got that company structure, something goes wrong, that fictional legal person, the company, is going to be potentially liable. But those behind it, unless they've committed fraud or done something that breaches certain laws, in most cases, those directors and shareholders are not going to have any liability. It's going to be limited to the company, which is why we call these things limited or proprietary limited companies. So you're already starting to get a sense of how one thinks about these decisions. A lot of people start with the sole trader partnership structures, but as they grow, or if they're doing something risky, the company structure starts to make sense, starts to help you sleep easier at night, knowing that if something goes wrong in the business, it's not going to come back to you personally. There's more to it, which we'll come to, sort of tax considerations and cost considerations, but that's the basic distinction between these different sort of sole trader partnership models. So moving on to more complex structures now, many people will just set up one company and that's their fictional legal person that's doing business. But there are more sophisticated structures, dual company structures and trust structures. And we've got three common versions on screen. Obviously, the single company on the left is one company. It will go out and employ staff, sign contracts, have its own bank account, hold all the valuable assets of the organization. But the dual company structure we've got in the middle, you can now see we've introduced a second company. So instead of just having one company, one fictional legal person, we have two fictional legal people. One is an operating company that goes out and does the day-to-day of the business, enters into contracts, sign things if their staff employs people. It is then owned by another holding company that has its own assets, important assets, and cash and other important things for the business, which is then in turn owned by the directors or the shareholders rather, and controlled by the directors. Why would you bother doing this? Well, we talked on the first slide about how having a company is going to protect you, the individual, from liability. So your important assets will be safe. But as your company becomes valuable, it might also have some important assets that you might want to protect too. So by setting up a second company, what you can do is you can store your most important assets in your holding company, and then you have your operating company that can go out and do risky things, sign contracts, do business. If it gets in trouble, the liability is limited to it. So it could get sued, or it could be fined or penalized. And again, in most cases, though, the assets of the holding company are not going to be on the line for mistakes the operating company makes. I say most cases because there are obviously some cases where laws step in and stop people circumventing these things. But in general terms, if you've got a holding company, it can almost be like the safety deposit box of your business structure. All of your important assets can sit in there, and then you go out and you have an operating company that sort of does business. Another advantage of having the two levels, for those of you that have ambitions to expand your business in maybe to multiple areas of operation, different business lines, or potentially expand internationally, once you have this two-tier structure, you can start to set up more entities. And each time you set up an entity, you're essentially siloing the risk of whatever that entity does from the rest of what your business does. So for example, Sprintlaw, we have Sprintlaw Group, our holding company. Then we have Sprintlaw Australia, or PTY Ltd, our Australian entity. We have Sprintlaw UK, we have Sprintlaw New Zealand, we have Sprintlaw Tech, which is sort of a tech entity. So we have 4 of these different operating companies. And what that means is if something goes wrong in Sprintlaw UK, the liability is limited to Sprintlaw UK. The holding company is a separate company, it's safe. The Australian company is a separate company, it's safe. The New Zealand company is a separate company, it's also safe. The tech company that's doing some tech stuff is safe. It's just UK. So an issue in the UK wouldn't blow up the whole business, if that makes sense. And certainly, the directors and shareholders at the top are quite protected. So you're putting these sort of shields in place, or these barriers against risk that might affect your organization by having these different companies. And so you can start to see why larger and larger organizations end up with many entities, all really about siloing risk. Now, while you're a small business, this can all seem overwhelming and too much. And if I look at Sprintlaw's client base, we have a significant portion who are just set up as sole traders. And not that many people use the partnership structure, because if you're going to that trouble, the view is often you may as well set up a company, particularly if you're doing business with others. So partnerships are rare. Some industries, traditional law, for example, it's conventional and there's regulatory reasons why you might be a partnership. But if you can choose, it's often better to not do this model. But a lot of our clients are sole traders. A lot have a single company structure. And then for clients of ours that are startups who are small but want to grow big, those with plans to expand internationally, and really anyone who wants to be a sort of growth business, that's where we start to see the dual company and the trust structure, which I'll come to in a second. So you should think about, and again, we'll come to some decision criteria in a second, what kind of business you are. And if you are one that wants to grow or wants to have multiple business lines and wants to expand internationally in the future, then you should be thinking about maybe this dual structure. If you are a small business that wants to stay a small business, you might be thinking about the single company structure. Now, if you're an individual, I should be very clear. Just because you're one person doesn't mean you should be a sole trader. Many one-person businesses are set up as companies, particularly if they're doing risky stuff for tax reasons, and also just so they can sleep better at night knowing their personal assets are on the line. So if you're a one-person business, sole trader or company may still work. If you're a multi-person business, but you're not planning to do any expansionary stuff in the future, and you don't have that many key assets in your business that you're worried about, then you might stick with a single company. If you're a growing business and you're starting to have quite a bit of cash in the bank account, you don't want to be on the line, the dual company can be a nice way to protect that. And certainly if you're planning to expand in the future, setting up the 2 levels early on so you can add more later is a really good idea. So that's the dual company structure and how it fits into the story. Now we'll just come on the right to the most complex structure we'll talk about, which is the trust-based structure. So you can see it down the bottom. This is very similar to the dual company structure. We've got the holding company and the operating company, but up to top, it's a little bit different. So what's happening here is the owners of the company have, rather than holding their stakes in the business themselves as people, have set up more companies, trust companies, which then hold the shares, and then only they sort of own the trust company, which owns the shares in the company. And so why might you do that? Well, you can see in these other structures that the people that own the company, whilst they may be protected from issues in the business, issues with employees, liability that the business may fall into, as between each other, they're doing business together. So they're not hiding behind companies when they're doing business with each other. So if two founders start a business, the two of them might be safe from an employee issue or a client issue, but the two of them are shaking hands and doing business together. They could be personally liable to each other, so they don't have protection against a business partner dispute. So one reason people set up these trust companies is it provides another shield from the founders of the company as against other founders or investors or other shareholders. So not only are they protected from employees or client issues, have they got the assets safe in the holding company, but right up the top, they're protected from the other shareholders. So this founder one has essentially three shields here from any issues: the operating company, the holding company, and then their own trust company. So it's a nice insulated position from a risk perspective. There's also tax advantages to the trust structure, and whether it makes sense for you sort of depends on your personal tax situation, but it can be the case that if the company in the future is sold or it issues dividends, having that money flow into a trust, which you could then potentially distribute to yourself and other family members or other people or other companies that you might be involved in, doing that can potentially be an effective way to manage your tax, versus if your company's sold and you just own the shares personally. In that year that the company's sold, all of that income is going to be declared on your tax return and be part of that year's income, even if you may not intend to spend it or manage it that year. So the trust does give you some flexibility in the way that you can manage the funds flow. I always say, lawyers are really great at helping you set up these entities, but when it comes to the trust stuff, it's really a tax question. And so accountants are a really great person to speak to. If you have a personal accountant or a business accountant, you can ask them, I'm going to be setting up a company for my business. Should I be holding my shares personally or through a trust? And they can look at your situation, tell you whether it's worth it. And we'll come to some of the costs of setting all this up in a moment. But this is very much a sort of personal question. I mean, there's the risk component and then also the tax component, and the latter of which I think is very much a personal question. But Sprintlaw, our structure, as an example, is this one on the right. I mentioned we have the Sprintlaw Group is a holding company. It has all of our intellectual property safely stored in that entity. We have our operating companies that's out there signing contracts and engaging clients. And we have the founders. I'm one of the two founders of the business. We hold our shares in the Sprintlaw Group through a trust. So I have the Alex Solar Trust, or it's called something else, which is a company that holds my shares in Sprintlaw. So that gives you a sense of how a company like ours, who you would hope does the gold standard thing as lawyers, might set up. It's not cheap. We'll come to that in a second, but it is kind of a gold standard structure for maximum flexibility. Katiki has asked, founders also the directors in the trust company hybrid? Yes, they usually are. I've sort of simplified because there's like three different types of trusts or more different types of trusts that you can set up. And there's whether you or family members or other people run the trust company can depend on personal tax considerations. So it's not a one size fits all, but the most common structure we see when people, particularly for startup companies who are doing the trust structure, is yes, the founder, if you will, would be the director of this trust company, the only shareholder of this trust company, and the beneficiary of this trust, without getting into detail. The reason that we use a trust instead of a normal company here is for sort of tax management, and so you need to have this thing called a beneficiary, which again is often the founder. And certainly for Sprintlaw currently, I'm all three for my trust. I'm the director, I am the shareholder, and the beneficiary, if that makes sense. Someone's asked, would there be any benefit to having a sole trader set up under trust? That's a bit of a overlap of concepts. So you can't really combine those two things. A sole trader is just you go out and you get an ABN and you're operating just as an individual with an ABN. The second you're setting up a trust, you're usually moving to a more sophisticated structure, and so it will be an alternative to being a sole trader. You could have, instead of having, which is potentially what you're asking, some people operate without doing the trust company hybrid. Some people operate a single company, but the company's set up as a trust. So it's kind of the equivalent of running your whole business out of just like this, and this thing goes out and gets customers and employs people. I've seen that structure be used with small businesses. I'm not a big fan of that structure. I think it works. Like, you can definitely run a business through a trust as a one-person trust, but it causes problems in the future. If you wanted to ever sell your company, it's very mixed in with your personal assets and your personal management. And so, when you have these, one of the big advantages of the company structure is you can sort of slice out the company and sell it if you need to, without it being mixed with your personal affairs, where if you start running your company through your trust, it all gets a little bit messy. Seppi's asked, can two companies become partners? They certainly can. I might not use the term partners because it can somewhat confuse with this concept of a partnership that's a legal structure. But in the colloquial sense, if two businesses want to work together and run a company together, they can set up a joint company. And so, for example, in these company structures, you can see this company is owned by a director and a shareholder. Equally, this company could be owned by company A and company B, own company C. That's often called a joint venture company when two companies work together. For example, Sprintlaw, if we decided we wanted to start doing accounting, we could, find an accounting firm, and maybe we would do a joint legal and accounting business, which we have considered before, and we would set up a new entity called, Sprint Accounting, which is half owned by Sprintlaw, half owned by accountants, and that's fine. And then we would, enter into a contract between each other, and that would be its own entity doing its own thing with its own risks. So that can be done, and again, that's often called a joint venture. That can be done without a company. You can just have two companies agree by a contract to go out and do something together. You don't necessarily need a third company to do that as well. So there's different ways to handle that, but certainly it is possible. Companies don't need to be owned only by people, as you can sort of see from the structures on screen. We've got a few good questions coming through. I'll try and deal with them, but we'll move along if we're running out of time. A question: when you're a startup, young company, even though the company structure provides safety, very often you're faced with the challenge of personally guaranteeing on behalf of the company, so it defeats the purpose. How to manage this? That's a good point. Yes, I have been saying as I go through each of these slides, in most cases, when you have a company structure, you're protected from risk. In most cases, when you have that holding company, you're protected from risk. As this person's pointed out, I've used the words most cases, but there are some cases where it doesn't work and you can't hide behind the company. And one of those cases is, we'll come to later in this presentation, is if you are running the company and you commit fraud or something else that breaches the law, then you can't hide behind the company. Another case is some organizations like banks that might lend money to you, they're going to look at your structure and go, okay, I see you've got the company, but if I'm going to lend you, I don't know, $50,000, $100,000, $200,000, you can't then say, oh, my company blew up and I'm going to run away and have paid yourself a nice salary. So they'll ask you to personally guarantee the loan. Or in some cases, if you've got a multi-company structure, they might ask for what's called a parent company guarantee. We want your holding company to guarantee the loan. We don't want to loan money to this little operating company down here that's avoiding risk. So you can be asked that, certainly. And if you do that, in those cases, you're right to say that it kind of defeats the purpose of having the company in the first place. I don't think that's a good reason to avoid this altogether. Those situations when you're asked for the guarantee are, in practice only when banks are loaning you money or, you're entering into large transactions. Day-to-day stuff when you're signing contracts with your employees or with your clients, no one's asking you for personal guarantees or holding company guarantees. And if they ask you for that, you can always sort of say no or manage the risk around that. So it is an exception to the rule, and it's worth being aware of. But again, I think that those cases for most businesses are the exception, not the rule. We had a question about NFPs. I'm briefly going to mention that in a moment, so I'll come back to that. I've got a question. I have XYZ Pty Ltd as trustee for ABC Family Trust with my wife and I as director. It sounds like a single company structure and not a trust. If Les, if that's how you're running your business at the moment, that's not one of the things I have on screen. That's what I was describing earlier. It sounds like you're running the structure where you basically have a trust company that's also running the business, and that is a structure that we see a lot. I'm not a huge fan of that structure, as I mentioned earlier, because I think it makes it difficult if you wanted to sell the business. It's tied into your personal trust affairs. But many accountants set that up for reasons so as to avoid having to have multiple companies because it can be cheaper to set up. So it is a structure that we see a lot. It's not unusual, and you can operate that way. It's just, as I said, has that limitation of like your business and your personal affairs can all be tied up into one. So you might consider separating that over time and setting up a separate company to run the business that might be owned as your trust. Vandana's asked a question about conversion. We'll come to that in a second. Alison said, if you set up a sole trader and are married, is your spouse liable? That's an interesting question. Your spouse may not themselves be liable for issues in the business, but if there are assets that you jointly own, your furniture at home, your property, if there's a house that you jointly own, it can be very difficult, in fact, because often there's not an explicit agreement in a marriage as to who owns what. A lot of their assets, and including cash as well, if they're jointly owned with you or mingled with yours, could all potentially be on the line. So while they themselves may not be liable if they're not doing anything in the business to make themselves personally liable, if they've got joint assets with you, yes, they can be on the line. Someone's asked, Alex, you're the director, shareholder, and beneficiary. Who's the trustee? In this structure here, we have a trustee company. So the trustee is the company, and then the person controlling the company is, in this case, me as the individual. But of course, I could have family members and other companies involved in future. So that's how the trust can often work. Can a person start providing a service before they obtain an ABN? Technically, if it's like a hobby or very low income, very early stage, there are some exceptions. But I can't remember the exact wording of the law, but it's something like if you're conducting a commercial enterprise, you really have to have some sort of business registration. So in limited cases, yes, but really very quickly after you start doing it, you should be registering that ABN. Otherwise, you risk breaching the law around not having one. Unless it truly is like a side hobby or you're selling a few things on eBay or something like that. Lots of good questions here. I might just move on, otherwise we won't get through the slides, and I'll come back to some of these at the end. Gerard's asked, who is your trustee? The company is the trustee, yeah. And again, if you've got specific questions about the trust structures, you do feel free to book in a call with the team because we can explain in a bit more detail how that works. But it's not a person; it is a company. So, just to round up the different decisions on which structure you might choose, you can have a look at this picture. I won't go through every single cell, but you can see the sole trader. It's cheap, it's simple, you've got control over it, but it's risky. There's liability. It makes it difficult to raise investment. The tax can be an unideal situation, and there can be issues with business continuity. All the way up to the other end, we get green in the bottom right corner, much better from a liability, capital raising, credibility, tax perspective, but the cost to set up can be pretty high. And in the middle, we have the company structure that's a nice balance of both, and the dual that's a bit more expensive but has some additional benefits. So you're really in this whole decision-making process, you're balancing how much money and complexity can I handle right now, and how much risk and benefit. And it will depend on where your business is at, which one makes sense. A couple of considerations is the following. And as I said earlier, I think if you've got plans to expand the business and really grow, these structures on the right are worth investing in. If you want to keep it small, stay small, you don't have much budget, and you're think you're doing the lower risk activities, you can stay more on the left half or in the middle. And that's usually how people think about these decisions. But I will say this, if you are thinking, oh, I'll sort this out later when I make a bit more money, right now I'm going to stay with my simple structure, that's a reasonable way to approach this decision. But a challenge is, coming back to my initial comment about it being the foundation of your house, swapping from a single company to a dual company or a single company to a trust structure, if you don't do it early on in your business, it can be complicated, it can be risky, and it can be expensive. So the longer you leave it, the harder it becomes. And just to flesh that out in a little bit more detail, imagine you're this single company structure and you want to set up the operating company. So you set up the operating company underneath this single company, and now you've gone from 1 to 2. Sounds great, but the problem is that holding company of yours, which is meant to be your safety deposit box, it's got all kinds of potential liabilities from all those years that you were doing stuff under that previous company, which is now the holding company. So it's not a nice, clean, risk-free entity. It's an entity that might have risk attached to it. Alternatively, you can do it the other way around. You can insert a fresh company above this company and make this one the operating company. But if you do that, you've got to sell these shares that you own in this company to a new holding company you've set up, and that there can be a CGT tax event. You might have to pay tax on the restructure. Now, there's ways around that, and there's restructuring reliefs, but you might need to get tax advice on it, and it can be a bit of a headache. Not to mention, you need to, in both cases, you need to consider like going to your bank, setting up new bank accounts, resetting up to all of your subscriptions, changing the name of your lease. There's a lot of administration in the restructure, and you might find yourself wishing that earlier on you'd set up the dual company. And the same goes for the trust. If you have the dual company but not the trust, and you try and move to the trust, you, the individual owners, might have to then sell your shares to these trust companies, and there can be a tax event that can be quite expensive if your business is already valuable. So, yeah, this is why people often do this fairly early on. So hopefully that gives people a bit of a sense of how to select the right structure. There are other structures out there. We've got NFP structures, which someone asked about earlier. We're not going to cover them in great detail, but if you are operating a business that is not intended to generate profits, or has a charitable purpose, there is something called an incorporated association, and there's also something called a company limited by guarantee. And these are different types of registrations that you can do. And with certain of those registrations, you can also apply for DGR status, which is a tax status that gives people deductions if they donate to your business. So these are different to all this dual company, trust company sort of things. It's kind of its own bucket of structuring. So if you are in that space, and Sprintlaw does help with those sorts of structures, I would suggest getting some specific advice around it, picking the right structure, because the consideration there is a little bit different. Some small businesses set up as unlisted public companies. This is different to a private company. It's pretty rare, so again, I won't spend much time on it, but it does exist for businesses that essentially have too many shareholders. There's a requirement when you get to a certain size that you have to start making more of what your business does public rather than keep it private. So that's another structure that exists. And for those of you who are startups that have considered equity crowdfunding or crowdsourced financing, which is a sort of newish form of raising funding, there's also different structures that you can use to set up or manage a company that are a little different to what I sort of described, because you may be taking on a large number of investors. So if you think you're in any of these buckets, I'd get some specific advice. But otherwise, for most small businesses, this is really the kind of spectrum of different structures that you might think about. And just to emphasize a few of the other points that I've kind of gone through, for your business, think about liability. How risky is what I'm doing? How likely is it that I'm going to be sued in the future by employee, business partner, client, is what I'm doing a sort of low risk, sort of activity, or am I worried? And that will help you think about how much that matters for your structure. How much budget do I have? Can I even afford these different structures? How much control do I want over the business? Am I planning on raising funding in the future? And then these different tax considerations. These are all the kinds of factors that you're thinking about when you're sort of choosing your business structure. So let's talk a little bit about changing structures, because some of you might be thinking, oh, I've already registered in a certain way. Now, Alex has got me thinking I should maybe revisit that or think about a different structure for how I'm operating. The changing process, look, it happens very, very often for businesses that they change their structure. The usual trigger points are you've started to grow, and you've started off really small, maybe as a sole trader, maybe as a single company. Now you're growing a bit, the company's getting more and more assets, and you're wanting to formalize sort of how you operate. So that's one trigger point. And again, sole trader businesses, often their invoices have their name on them. And it's part of their personal tax return. It can look more professional to really just have a company that's set up. So there's even optics reasons to consider company structures. So that's one trigger point. Another is the liability concerns. If you're taking on more and more risk, or you just want to sleep a little better at night, knowing that if things happen in the business, you're generally going to be safe. That's a reason people will make the change. Succession planning. I mentioned earlier, if you plan to sell your business, the structure matters. We talked about the limitations of just running the whole thing through a trust. Same thing, if you're a sole trader and you want to sell your business, it can be harder when the business assets are all tangled up with your own personal assets, where if you have a company structure, you can potentially just sell that company and it makes it easier to sell, or if you want to pass it on. And finally, there's these tax efficiencies that we're talking about. And again, company tax rates can be lower than individual tax rates. When you pay tax as an individual, you've got in Australia the progressive taxation system. Companies have, in general terms, a flat tax. And so again, if your business is earning over a certain amount of money, it can be more effective, to have that company tax rate on your profits, and then have more budget in your company to spend it on other sorts of things. So this is another trigger point. So again, if you're thinking about it, consider these factors, and that would be a trigger point. And the restructuring process, as I said, it's a little bit of a headache, but it's doable. And the earlier you do it, the easier it is. This is kind of what it looks like. You pick your new structure. There's some documents to prepare. You would register your new entity. You then got to figure out what happens to the assets. I'm going to transfer my business IP, any things it owns, any contracts it signed. I'm going to transfer that to my new entity that I've set up. If you've got employees, you might have to move them across to your new entity, so they'll sign new contracts, your suppliers, and so on. You want to obviously make sure that you're across any employment laws or tax laws that might be affected by the change in structure. If you went from a sole trader to a company, there's new tax returns and filings that you have to make. And then finally, you need to update your bank accounts, payroll systems, signage if you have your entity name or business name on anything. So this is kind of when I say there's administration, this is sort of what it looks like. The specifics will depend upon your business, but that gives you a flavor for what a structure change might look like. So we'll talk about business names. I might just quickly turn to the Q&A because I've seen a few questions come through. Tony's asked, I have a new startup company and it looks like I have to scale up straight away. Indemnity has to be increased from 2 mil to 10 mil before we've started trading. Should I be looking at setting up a dual company? I have an AI company and about to approach a very large corporation. So I guess I should say, obviously that's a very specific scenario, so I don't want to be providing advice without considering your situation in detail in the webinar. But just to pull out some of the concepts that you're discussing. So, for technology companies with potentially valuable IP, yes, that dual company structure is often recommended, because if there's innovations that you've made around AI technology, having it stored in your holding company is you want to keep it in a safety deposit box. You don't want to be signing up customers and then have your software system potentially liable. Oftentimes technology companies will hold their technology IP in the holding company, and then they'll have the operating company. So yes, particularly if you're raising investment, this model can be better. The investors' cash can sit in that holding company too. When you talk about indemnity, you're really there, I think, talking about insurance. I'm not dealing with insurance here. Insurance is a separate thing that also protects you from risk. And if you are a sole trader, legally you could be potentially liable for anything that goes wrong in your business. But if you take out a business insurance policy, your insurers might cover your losses to the extent that they allow your claim. And so for most businesses, when you're thinking about this question of risk, the structure is a big consideration because, like I said, the company and the dual company and so on have all these benefits. Insurance is another tool that you can use on top of this. And so, if you want to be extra protected, you have the trust structure with a very comprehensive insurance policy. And the least protected is a sole trader with no insurance. So, it's a spectrum. Most people, I would suggest, set up some kind of business insurance as well, and you'll have the dual protection of insurance and a company structure. But yes, that question that you raised about indemnity is a bit more of an insurance question rather than being relevant to the structuring. Alex has asked, if you set up an Aussie company, then have potential partners come in from the UK, is that okay? Or would you need a separate company set up in the UK for the business? So with international expansion, there's two aspects to how one thinks about it. Shareholders or owners or directors of an Australian company do not have to be Australian. You can have English people owning the shares in your company. You can have a UK resident who's an Australian company director. The only Australian residency requirement for setting up a company is that you have at least one Australian resident director. So you do need one person who's a director of the company who is an Australian resident. But the second and third don't have to be, and same with the shareholders. So you don't need to do any separate setup to bring someone into the business. Now, if you're expanding to another country, you want customers in, for example, the UK, they have a similar law to Australia. If you want to conduct business in the UK, you need to be registered as either a sole trader or a company structure. So most times when you set up in another country, you'll set up a company there to service customers there. And usually it'll be a subsidiary of your holding company, although people do all kinds of complicated things when they expand internationally for different purposes, and it depends on the laws of the country. So that's kind of how you might think about that internationalization aspect. Someone said, if you have more than one startup company that you're working on, should you set it up as a trust straight away, even though you're not making any profit? A couple of concepts are embedded in that question. If you're operating more than one business, it's usually strongly recommended by lawyers that you have separate companies for them, because if something goes wrong in business one, you might not want it to affect business two. So it is usually sensible to have two different companies or registrations, business registrations for two different companies. Whether you choose to set them up as companies owned by you or companies owned by your trust is a personal decision based on some of these factors around your own risk appetite and balanced against the cost and tax circumstances. So you don't have to though. It just depends on your personal tax situation. So the trust thing in general, for people with questions about trusts, if you're interested in that structure, I would maybe have a conversation with an accountant, because there's a bunch of personal tax information that needs to be answered about you and your family. But the trust is really often a tax consideration. It does have that legal benefit I mentioned in protecting you from business partners, but tax is often the main driver. Conscious of time, I will try and get to, there's a lot of great questions here. I will try and get to all of them at the end, but let me just keep going through. So you've got your business structures. We've talked about how to change them. And now just moving on to the name of your business. So this is a really big misconception. A lot of people think that when you choose your business, your company name, when you set up your company, that's your name and you own it, and you got the name. And there is a rule with ASIC that you can't have two companies with identical names, but that is not any form of legal entitlement or ownership to you of that name that you've registered. There's two other registrations that you need to think about if you set up a company, and also if you set up a sole trader ABN. Two other registrations you have to think about to make sure you got that name. The first is there's a requirement that you register your business name separately using a business name registration with ASIC. It's pretty straightforward to do yourself. You can just Google business name registration ASIC, and the government website should come up and help you do that yourself. And if you use one of the online set up your own company services, or you do it through a lawyer, they'll usually handle this for you at the same time. But it's technically a separate registration. And basically the law says if you are using a name for your business publicly that's different to the name attached to your registration with us, then you need to have registered that. And the reason is because the public might see your name somewhere online or on a sign, and they should be able to go online and look up who is behind that business name, what company is behind it, or what individual is behind it. That's kind of the public policy reason for this. So it is a separate registration. It doesn't cost that much. It's, I think, $30 a year, or maybe a little bit more now, $40 a year, and there's multi-year discounts. But it's a requirement. So, for example, we've got a company called Sprintlaw Pty Ltd. But because we don't write Sprintlaw Pty Ltd everywhere, we write Sprintlaw. We need to register that as a business name. And if your company, it can be called whatever you want. It could be called, ABCXYZ Pty Ltd. That's fine. But if you go out there with a business name that you're putting on your website, and you need to do this registration, it's an administrative requirement, but you need to do it. So that's an important thing to remember. Now, even if you've got that, a lot of people think, okay, I've got my company name, I register my business name, I own it. Even then, you still don't own that name. You've just not broken the law. To actually own the name and stop anyone else from using it, you have to register this thing called a trademark. And a trademark will give you the exclusive right to use a word, a logo, a phrase, there's a bunch of other types of trademarks, in your industry in a particular class. This means, for example, for Sprintlaw, we own the trademark for the word Sprintlaw in the legal industry, and we own it in Australia, and we've got another one in the UK and a bunch of other regions. That means no one else in the legal industry can trade using the name Sprintlaw. They can't even have a product called Sprintlaw. They can't even do things that would be deceptively similar to Sprintlaw, Sprint Legal, Sprint Lawyer. That we get through the trademark, and that's the strongest protection. And if you've got the trademark and someone else starts using a name or something that's quite similar to yours, you can send them cease and desist and potentially sue them for trading off your name. And equally, it's the other way around. If you go register a business, but turns out that someone else has that as a trademark already, then they can sort of come after you for infringing their trademark. And we've had a lot of clients set up their company, set up their business, go out and start trading, and then a large company had a division of their company with the same name as this small business, and that company had registered trademark, and they say, oh, sorry, we're going to sue you for all kinds of money unless you rebrand. And often that can really kill the business because they've set up their website, they set up their branding, but they never thought to get that trademark. So if you don't have a trademark, it's actually the number one biggest mistake we see with Sprintlaw clients is not having the trademark and having to rebrand. Definitely consider it. IP Australia is the body that does trademarks. It's not ASIC. IP Australia has a new tool where you can search your name and check if anyone else is using it already. We provide trademark services for those that want help registering. It's not that complicated. It does take time. But again, you got to set up the company name, get the business name, and then get the trademark, the trio of things to really secure that name. So I just always want to make that clear. It's my personal mission to educate people about trademarks because it really is the killer for a lot of small businesses. A question about business names came through. If you have a very basic business name, how do you attach a marketing name through Kmart, KFC, Joe's Plumbing? I don't fully understand the question. I'm not sure if you're asking can you trademark a very basic name, or maybe Les, you could just clarify that question, and I'll come back to it in a bit. So just to cover a couple of things, I've said through this presentation with these business structures, generally you, the individual running the company, are protected from personal liability for issues that may happen in the business. And I keep saying generally, we talked a little bit about those parent guarantees. Now I want to talk about the other aspect. So you're generally protected from liability with these structures, provided that you as a person running the company, which is, as we mentioned earlier, the person who signs the contracts and, controls the company is called the director. You as the director of the company don't break the law. And the law says the following things, a bunch of things, but these are the key things it says about running a company. You have certain duties. One, you have a duty to act in good faith, always act honestly and in the best interest of the company. Two, you have a duty to exercise care and diligence. So, you got to understand the company's financial position. You got to make sure that you're not out there doing business when you can't pay your bills, which is a specific law. You can't trade while you're insolvent. Three, you have to avoid conflicts of interest. If you are controlling the company in a way that benefits you personally while at the advantage of other directors or other shareholders of the business, you got to make sure you've got approval to do so. You got to not improperly use your position, keep proper financial records. You have these duties to responsibly run the company. If you are committing fraud or if you are acting in a way that's dishonest or you're manipulating the way the company's run for personal gain and doing things against other directors or owners to benefit yourself and not the actual business and organization, in these cases, you can be personally liable. The company won't protect you as the director. And so this is an exception to the general case that you're protected while you have the company. Directors can be personally liable. In the law, we call it piercing the corporate veil. The company protection can be pierced in cases where the directors breach their duties. So you got to be aware of these duties when you're setting up a company. ASIC has great, easy to understand explanations of them. If you're operating it in good faith in general, which is duty number one, and making sure you stay on top of your financials, making sure the bills of the organization are paid, making sure that you're not you're acting honestly in collaboration with the other directors, this can really reduce these risks, but it is still a risk. There is insurance you can get, directors indemnity insurance, that helps protect against liability of directors personally. That's always a good thing to have. Even better is to make sure that you never end up in a situation where you've breached these duties, but people often get insurance as a secondary protection. But very important to be aware of these things, and a bit more detail here, which will circulate with the slides on what those things are. And just the final slide before I dive into these great questions that we have. I just wanted to quickly run through some of the legal documents people might have heard of and tie them back to what we've been talking about. So when you're setting up the company, there's a registration component, or the business, there's a registration component. As I mentioned, largely done with ASIC or through your lawyers and accountants. If you're getting that business name, that's also done through ASIC. And finally, if you're getting that trademark, it's through IP Australia. So much of it is a registration process. There's also legal documents that you need to put into place. So if you're a partnership, which is that structure I said is not that popular, there's really only one document that you need, which is a partnership agreement between the business partners explaining how the partnership is run. When you set up the company structure, there's a few more legal documents that are recommended and required to put together. A constitution, usually this is automatically generated if you register the company through an online tool or through lawyers and accountants. But it's a document that explains how the company functions, what directors do, how meetings are called, how decisions need to be made. There's a register that needs to be kept, which is a document setting out who the directors are and what they do. Again, a lot of these documents are auto-generated for you when you register the company, if you do it through a third-party provider. A recommended document is a shareholders agreement, which is very similar to a partnership agreement, but it's what's used in a company context. So this is a contract between the different owners of the company, those shareholders, describing, again, how decisions are made. What if there's a falling out between business partners? What if one person wants to sell and the other doesn't? It's sort of like the business partner agreement. Strongly recommended if you're entering into a company with other people. Similarly, there's often a directors agreement which protects the directors from these issues that I mentioned here. The directors often says the company will cover the director's costs if there's any issues with their director's duties. So that's often a thing that's put into place. And if you have those dual structures, we talked a lot about how when you have the dual structure, the IP sits up here, the cash sits up here, the day-to-day sits down here. You need to have a document between the two companies which actually does that, which says anything owned by the operating company will be immediately transferred to the holding company and licensed back to the operating company. So there's a little bit of administrative documentation you need. And similarly, if you set up a trust, there are some trust-specific documents. So again, if you work with a professional to do these, they'll take you through all this stuff and handle it for you. But it can get a little complicated. And again, particularly for the structures that are not sole trader structures, partnership structures, like if you're doing a company, dual or trust structure, I would suggest getting professional help. You can set up a single company structure yourself. It's not that hard now. So if you've got a fairly straightforward single company and you want to save the money, you can do that yourself. But just be mindful there are these documents that you want to consider putting in place. And anything more sophisticated, given the complexity, I would suggest professional help rather than trying to do it yourself. So that is the content for today. I'm going to run through these great questions. Conscious we're at 2, but I'll probably go for another 5 to 10 minutes for those interested in hearing the answers or wanting to ask other questions. But hopefully you found this useful, and we do these every month. So yeah, please come along to the next one and check out Sprintlaw if you haven't already. So let's go through some of these questions. So I'll go from the bottom. Tony's asked, I have a registered company here in Australia and someone in New Zealand would like me to do some automation of their company over there. Do I need to register in New Zealand? That's an interesting question. And it's not easy to answer in the abstract. So I would suggest booking in a chat with our team to get a bit more information on that question, because I think we need to analyze what you're doing and how much you're doing it. In general, it's possible to have like a single client in another country without triggering the need to set up a whole entity there. So it's probably possible to do it if it's just one client without registering a company. If you're going to conduct an ongoing business in New Zealand, then you may actually need to do that local registration. So it depends on the circumstances. If it's one-off, it's probably possible to structure it in a way where you don't trigger those New Zealand laws. But it is worth getting some advice on, because it depends on the specifics of what you're doing and how long it's for, and so on and so forth. Jared's asked, what's the maximum numbers of directors and shareholders for a PTY Ltd? Good question. Shareholders, there's a 50 limit of the number of shareholders that a private company can have. Otherwise, you've got to translate to that unlisted public company or go public. There are ways to consolidate your shareholding if you end up with more than 50 shareholders, and there is an exemption if you run one of those equity crowdfunding based structures, but in general it's 50. Directors, I actually don't know off the top of my head, but it's there are definitely companies I've seen with 8 to 10 directors, so that might be one to Google and check, but it's not like it's 2 or 3 or 4. You can have quite a lot of directors of a company. So there may be a limit, but I'm not sure exactly what it is off the top of my head. We've had a question. I have a new startup company set up as a single company. The startup will develop technology and contents that are IP protected. What are the benefits of setting up a dual company structure? I think I covered this a couple of times in the answer to that AI question, but just to reiterate, if you've got technology that is original and could be valuable, if you have a single company structure, you get users of your tech, you sign contracts with people, you sign up to a lease or an office space, you sign all kinds of contracts. Something goes wrong at some point, your company is sued, your innovative software could be on the line if it's all held in the single company structure. So it's a bit risky, basically. Whereas if you have the holding company structure, you can have a little contract that moves all that IP into your holding company, and now it's safe. And if something goes wrong in your day-to-day operations, that technology is safe. So that's one reason, a safety reason. A second reason is if you're a technology business that might want to raise investment in the future, investors care about what I just said, and they like to see this structure. Also, if you could expand internationally, having 2 levels from early on will make it easier to expand internationally. So there's a ton of reasons why you might do it. It obviously costs a bit more, but it is often better for technology companies with valuable IP. Another question, at which point in terms of revenue or stages would make the most financial sense to turn to a single or dual. Look, it's not really just a revenue decision. I look at it as kind of this decision. How risky is what you're doing? Can you afford the dual structure? Like the cost, it's like Sprintlaw charges, I think, somewhere between $700 to $900 for a single company structure, and then $1,500 to $1,700 for a dual. So the registration costs more, but not tons more. Then you've got to do 2 tax returns each year. But often your holding company has no revenue, so it's a simple $200 to $400 return. So you're looking at an extra $1,000 set up and an extra $200 to $400 a year. So you're weighing that against other things, all the considerations I just ran through, liability protection, et cetera, et cetera. So that's the best way I can put it. If you are generating real revenue in your business, that your company would be valued at something more than $0 were it to be sold, it can be more and more expensive from a tax perspective to restructure. So accountants are usually good at finding ways to do the restructure that doesn't cost money, but it gets very difficult if you're generating significant revenue. What is significant revenue? I can't tell you that, because it's not actually about revenue. It's about the business and its inherent value. All I can really say is the earlier the better. That's how much it costs, and here are the considerations. Again, something to think through. You can get advice from lawyers and accountants for your specific situation. Jared's asked, what's the limitation on shareholders and directors for a PTY LTD? I think I covered that already with these directors' duties, but essentially, in general, neither are liable. Shareholders, it's very hard for shareholders to be liable except to each other. They're very, very rarely liable to end customers. Directors can be liable to other directors, to shareholders, and sometimes to end customers if they break these duties. Otherwise, everyone is protected from liability. Liz has asked, how do these rules and concepts apply to donation-based companies, ABN services? I talked a little bit about the NFPs. I probably don't have time to go into great detail on how that stuff works, but if you do want to chat to our team about that, do feel free to reach out, because we have a bunch of lawyers that work in that area. Stan's asked, use a trust to hold IP goodwill to charge fee to operating company 50% CGT discount when sold. That is, I think, he's explaining a common thing that accountants will recommend when you do the trust structure, which may work depending on your situation. So I think for those interested in the trust structure, there's things like that you can do that may make sense for your personal situation. Alison said, if you want to have a company that offers different services such as retail, freelance, marketing, and accommodation, would it be best to set up a dual company structure? Best, hard to say, again, without more specifics as to what the right structure is. You could have multiple companies that are unrelated to each other doing that if they're going to have different business partners. You could have one company with, different operating companies for each business arm. It could get expensive because you've mentioned 1, 2, 3, 4 different areas there, and complicated to have 4 different companies. So it just depends on the scale. And it might be that you start out all in one company and transition. Like I said, there's downsides to that, but really to decide whether you do it all in one or in multiple, you're weighing up the cost and headache of managing 4 companies with the liability concerns. Like, is it the case that you're worried that an accommodation client is going to ruin your freelance marketing business? If the answer is yes, then you might want to separate them. If the answer is not really right now, but maybe in the future, then you're kind of weighing it. So it's definitely not a black and white answer, but I would be weighing the complexity of having so many different entities with how big you are. Definitely a large company with those different divisions will be looking at having different companies for them, but whether it makes sense at a small scale, it can get a bit complicated if you try and silo very specifically. I'll just go from the top again. I think we're nearly there. We've talked about NFPs, so I think that's okay. Vandana's asked, can you convert a single to a dual at a later stage when the business grows? I think we covered that, that you can. Fiona said how to transfer a Australian ABN registered sole trader company to New Zealand. Is that possible, or must close in AU and set up in NZ? New Zealand legal is a little bit outside the scope of the presentation today, but usually people will set up separately in New Zealand rather than transferring is the answer to that question. So if it makes sense and you need to, it would probably be done that way. Seppi said, I have a family trust, holding company, operating company. How do I have to separate the assets? Do I have to manually do the transfers? So the main document that you need, if you don't already have it, is an intercompany agreement between the operating company and holding company, and that's what will do the intellectual property separation. The bank accounts, chat to your accountant if you haven't already, but if the safest thing to do is to have the holding company have the cash in its own bank account, not have all the cash sitting in the operating company's bank account. So you might need to open a new bank account if you're not doing that already. Again, depends on your situation and if you want to do that, but that's the safest thing to do. With the trust stuff, that's again handled with your accountant as to when money flows out of the company, how does it go to the trust and then back to you. So chat to your accountant. You probably need a legal document if you don't already, is the short answer to that question. Les, I think, has reset his question. If I register a very basic company name, e.g. ABC Pty Ltd, but you want to trade as something other with a more catchy name, e.g. Joe's Plumbing, what do you do? Okay, I see what you mean. So yes, that's kind of what I was covering on this business name slide. You just need to register a business name and a trademark. So you have ABC Pty Ltd, that's your company that you've registered. That's fine, but you can't go out and call yourself Joe's Plumbing without having registered the business name for Joe's Plumbing. So you would need to register a business name for Joe's Plumbing. Otherwise, you'd be breaching a law that says you're trading with an unregistered name. So that's number one. And number two, if you want to own that Joe's Plumbing name, you need to register a trademark in Australia, potentially. Sorry, 1 second. My audio just dropped out there. You need to register a trademark in whichever industry plumbing falls into, and that will give you the exclusive right to use that name. Finally, would Sprintlaws have seminars on company evaluation in future, how company structures would affect the evaluation? We don't really do, I assume you mean like valuation or valuing companies. Lawyers don't really do valuations. That's more, again, accountants or company valuers. So again, if you're interested in working out what your company's worth right now, I would consider reaching out to an accounting or tax advisor, and they can point you in the right direction. What if your business name is the same as your Pty Ltd name and both are your surname? Technically, you still need to register a business name. ASIC is unlikely. Like, it's Sprintlaw Pty Ltd is our company name, and our business name is Sprintlaw. They're different because one has Pty Ltd and one doesn't. So I'd say the same to you. So technically we have to register both, and it's not that expensive to register both, so I would. It's extremely unlikely that ASIC is going to fine you if they're the same. So some people don't do it. So you may not bother, but yeah, technically you should. If you read the law, it requires you to do both. The surname aspect doesn't really matter. It's just about whether the word is the same as the Pty Ltd. The fact that it's your name is not really relevant. Ravenna said, as a sole trader, can I use my personal ABN for my business, even though I have registered a different business name? I think I understand what you're asking, and I think the answer is yes. Like, for example, when my very first business I set up as a sole trader, I had registered an ABN for Alex Solo, and then I registered a business name which was attached to my personal ABN for my first business, which was called Digital Canvas. So I had a business name called Digital Canvas and a personal ABN. So that's how you would set it up if you want to have a personal ABN and a business name, but the business name has to be attached to your personal ABN. So if they're not attached, you need to make that attachment happen, which you can with ASIC. Les has asked to go to slide 2 on director liability, which I think is this one. Yeah, we'll circulate these slides, Les, if you want to get a copy of them. We send them to everyone who attended, and there's a recording of this video for those that want to revisit it. Okay, well, thanks to those that stuck around. I really hope that you enjoyed this presentation, and thanks for the great engagement and questions. As I said, we'll run one next month. If people have feedback or would like to see anything else covered, let me know. Otherwise, I'll see you all again then.